Well, the waiting is finally over, and we have the answer to that all-important 25 versus 50 rate cut debate. The Fed have essentially told us how they're seeing things evolve and the catalyst to going forward. But have we really learnt anything new? And Blake and I discuss those factors in the trade-off today. We also look at setups on the US dollar, how we see this going forward. We look at gold, we look at equities, and we look at rates as well. But after what was a truly, truly bruising night for traders, we get in front of the screens again. This is the trade-off. Well, hi there, I'm Chris Weston from Pepperstone, and we're joined in 2 seconds by Blake Murray from Forex Analytics. So we are going to be discussing the Fed meeting, where this goes going forward, and of course all the markets, the fundamentals, the technicals that shape the probabilities going forward. Mr. Blake Murray, I'm guessing you're pretty exhausted.
My neck hurts. Yeah, I'm good. Yeah, it is. It's been a long day, Chris, and nice to be here with you all.
Yeah, certainly. I mean, I was up at 4 o'clock a.m. to bizarrely have a look at this and manage the risk over the positions, and I happened to wake my 6-year-old up in the process of doing so. So I'm in the doghouse at the moment at home. So there we go. But yeah, obviously a lot of tired eyes, and some of those, the reversal we saw in markets is definitely worth exploring because it was pretty violent, and I guess it sort of leads us to the idea about where we go through here. So without further ado, I think it's probably a good idea to dissect that. Let's go to Topical Thunder. The Fed meeting, Mr. Blake Morrow. Well, there was two parts to it, really. Obviously, you got the Fed statement. We got the 50 basis point cut, which was slightly preferred or slightly given a higher probability in the swaps market pricing. Obviously, the Wall Street Journal article, the FT article, and Dudley's article on Bloomberg probably gave us that little bit of a sway, and they seem to be on the money. We got the new set of dots plots, we got the new economic projections, and then Jerome Powell stepped up to the mic, and then big reversals playing through. So, ultimately, what did you take out from the Fed?
Well, Chris, I prepared for this, and you're right. Nick Timros, he'd kind of given us the Fed whisperer gave us a fair warning, if you will, a couple of days ago, and I didn't think they were going to go through with it. I actually thought they were going to cut just a quarter, but we'll go into the reasonings why the Fed chair thought that 50 was appropriate. But the fact of the matter is, it gave us a lot of opportunity to trade. The initial knee-jerk reaction put the dollar index below support, and that's what I was looking for on a 50 basis cut right out of the gate, out of the statement. And once you got that, it gave you the opportunity to get long some dollars, and as it gave us a little false breakdown. So I played it the way I wanted to play it. I played it the way I was thinking it would work. Well, I was hoping it would work out a little bit differently. I was hoping the Fed would have gone differently, but I was prepared for the situation, and I think so were our traders too. And I think the takeaway is, we're going to talk about that. There's a lot to take away with this one. Yeah,
no, I think the 50 basis point cut was clearly them making up for what, in hindsight, they would have liked to have done in July. They would have liked to have gone 25. They made that pretty clear. So that was a bit of a catch-up play there. For me, the dots themselves were less dovish than expected. I mean, they're calling for 4 rate cuts next year. I think, swaps have been pricing in 150 basis points of cuts next year, so 6 rate cuts. They're only signaling 4. So that's probably a bit of a dollar positive, rates negative situation playing through. But for me, let's talk about Powell, because whilst we saw that initial sell-off in the dollar, gold rallied up to 2,600, equities had a bit of a spike. For me, the sounds of celebration within the Fed that they're winning this one, that they're in control, that they've got their war on inflation is done, and they're very much guiding to a soft landing. It's a positive message, and subsequently we saw risk reverse a little bit on the back of that, and they're talking about only going in 25 basis point increments, but there was a bit of there was a strong reversal playing through. But you've got a Fed who feel very much in control of this move right now, right?
I think so. And, a couple of things, a couple of comments to that. First of all, this could have been the buy the rumor, sell the news event. So you got the reversal. You got the reversal in equities. You got the reversal in the dollar as a result of the buy the rumor, sell the news. But also one key thing that he said that this is not the pace to expect, or I'm paraphrasing here, but this is not the new pace. Basically, this was not one and done, but 50 basis point cut, and we'd have to have some real deterioration of economic data for them to give us another. So.
Yeah, no, I agree. So I think you're moving on into the into the future effectively, and the question, of course, is there a likelihood that we could get a 50 basis point cut? So I think there really is. I think there's a very good chance we go into November debating 25 versus 50 again.
Well, that might be the case. And, that's where we have to start talking about the market reaction component to this, because as you pointed out, we got some pretty big reversals today. And the biggest one, I would say, is the equity markets. The S&P reversed at all-time highs. We hit intraday new all-time highs, reversed, closed near its lows, got a little gravestone doji there, setting up. The dollar, like I said earlier, it probed below new trend lows and it reversed, gave us a little false breakdown. Why do you think, Chris, that we got this reaction? Was it just a simple buy the rumor, sell the news? The market was too ahead of it here. I mean, how are you going to explain it to everybody that sees the news, says, oh, the Fed, raise interest rates by 50 basis points, yet the dollar rallied? How are you going to explain that to people?
Well, the first move wasn't the last move, and yeah, I think they sort of laid the foundations, with the dots, saying that we're only going to get, 2 more 25 basis point cuts this year. The market was looking for more, and for 4 next year, the market was looking for more. So we kind of overlooked that initially, but then when Powell spoke, he said that, as you said, he's going to be looking to their base case is that, further cuts are going to be done in 25 basis point increments. They're going to get to a neutral rate, which they have no certainty where that neutral rate is, or clarity around that. But they're going to get there slower than where the market was looking for. They've also talked about, they're not looking at changing their plans on balance sheet runoff. But ultimately, they're still seeing a very strong labour market, and there's just no urgency that people were looking for. So, yeah, I think we saw that playing through, and two-year Treasury rate yields rose about 7 or 8 basis points on the back of that. Yeah, the dollar yen pushed up at 150 odd pips or so. Gold traded from 26, lost 50 basis points pretty quickly off the bat. But I think that was it. We're looking at a Fed whose base case now is that we're going to see 2 more 25 basis point cuts this year. But what's really important here is that they are standing ready to do. They could easily go 50 basis points again if the labour market fragility shows there. So, we've got 2 more non-farm payrolls numbers before now and November meeting. There is no October meeting. And they've told us they're looking very closely at the revisions. They're telling us that the beige book's going to be very influential. It's the most boring thing to read, but that's going to be an influence for them. And we could easily, if the pace and payrolls declines, if the unemployment rate pushes up to their forecasts quicker, then we could easily be talking about a November 50 basis point cut again. They've told us they have the propensity to do it. So, but I think the market did see those signs there. So, what are you thinking?
So, Chris, are you saying that we're data dependent again?
So nothing's changed. If we went into this thinking, what is the Fed's? We want clarity on the Fed's reaction function. We still want that clarity. We're still really not. We understand a little bit more, but we're still trying to understand the reaction function. We're probably likely to go into November meeting debating 25 to 50 basis point cuts. We're very much data dependent. The Fed are. I don't think it quickly has really anything changed. Have we really got anything new? Any new clarity on that?
No, just a mechanical 50 basis point cut, and I think we have to just tuck it away and forget about it and continue to march on. So.
Yeah, to be honest, I'd love Elizabeth Warren to be managing the Fed, to be honest, because I think if anyone who loves a bit of volatility, I think if we had Liz Warren, basically massaging the Fed funds rate down so that her equity positions benefit, I think, that would send some volatility. But that's another story right now. But look, we talked about what's happened there. What's interesting here, let's talk about the US dollar, because what we've seen through that hour-long process from the moment the Fed statement dropped through to the end of Jay Powell's presser, I mean, that's a nonsense period, to be honest, because you've got thinner liquidity at top of book, you've got all these positions which are being unwound as the facts are known, and I think now we're in a sort of calmer situation. All of that positioning's unwound. We've got a much cleaner situation. Calmer heads prevail, and we can really, really think about the outlook here. But the dollar has been on an interesting ride through this situation. So, I'm looking at dollar yen very specifically because that's been the move. We've got Bank of Japan, which is going to be a non-event tomorrow, and we got CPIs and various factors. But I quite like dollar yen lower. I think what we're going to see with the dollar, Blake, is that with the Fed now starting, I think you see much idiosyncratic moves. Harry may looked at, but you're not going to see one size fits all across the dollar pairs, dollar Swiss and dollar euro. Dollar yen will go down, but you might see growth currencies doing a little bit better. So you're going to get those splits. So where are you looking right now as the sort of the big opportunity in the dollar?
Well, first of all, I think we're going to squeeze. I think the dollar is going to respect these lows, and we're going to be in more of a range environment. But it really, you can't really talk about the dollar without looking at, twos and tens and, yields. And what we've seen, like in notes, for example, they hit a new trend high, and relative strength was majorly divergent. It's playing through now, but it's not just the 10-year notes. It's not just the 2 years, it's not even just the 30-year. You look at boons, they're selling off too. So I think this move that you're seeing higher in yields, it is going to reflect the dollar yen. And now I know you say you like the dollar yen lower. I'd agree with you eventually, but I don't know we need to talk about what's coming ahead. We also have the BOJ as well. But I want to point out that everybody's mother's, brother's, uncle's, nephew's monkey that doesn't talk about currencies on a week-to-week basis like we do, or a day-to-day basis, they are very yen bullish. And you've seen hedge funds flip from, net yen, carry trades shorting yen to now they're net long. I think they're going to get their butt handed to them. In other words, I think the dollar yen trades up to 145, maybe even 147, maybe even 149 before we start to see some downwards pressure. So I think the dollar's got some legs here behind it. The euro maybe back down to 110, and who knows what happens with the sterling following the Bank of America tomorrow, or Bank of England. It's late in the day, guys. I got up at 4 o'clock too, and it's definitely late in the day, in the evening for me here. But speaking of which, Chris, we should probably move to our next topic and the last topic. Let's talk about like different catalysts and looking ahead. As I mentioned, we have the Bank of England now. A lot of you probably going to watch this after the Bank of England rate decision, even though the show will be out before then. But we got the Bank of England. We've got the Norges Central Bank. We've got the Bank of Japan that we were just talking about. And then we have the Swiss National Bank next week, the RBA, Europe Central Bank next week. We have, and then a lot of data that we're going to be really focused on. As you said, we're going to be looking at the the beige book, the boring book. We're going to be looking at that too. And we're going to be focusing more on data and other central banks and what they're doing. And as you pointed out via Twitter, and if you guys don't follow Chris via Twitter, you have to.
So done.
His Twitter handle will be down there. But you mentioned that Brazilian central bank just raised rates. Everybody else is cutting rates. So what does that mean for the rest of LATAM? So Chris, looking ahead, now that we're past this big, epic, the most epic FOMC event ever in the history of everness, what are you looking at now?
Yeah, you make it's hilarious. I mean, we talked about this, the most important central bank meeting for like ever, and the S&P closes down 0.3%. It's I think Powell would have taken that one, to be honest. But yeah, like I think if the Fed are telling us that they're interested in the payrolls revisions, so are we. The next payrolls number is going to come up on the 4th of October. That's going to be the next biggest risk that we've ever seen. Like you talk about the beige book, I think the next beige book comes out in late October, so 24th of October or so. So it's a bit of a while away, and that's just one that you just want to keep avoiding, to be fair. It's but yeah, I mean, you've got the election. Obviously, we're going to start focusing on that one as well. But yeah, for me, the Bank of England's probably a non-event. They're not going to cut rates, and that they'll probably start cutting rates again in November, maybe December as well. The Bank of Japan, complete non-event, absolute non-event. Governor Ueda's press conference later in the day will probably be something we're looking at. They're in a review period in Japan after raising rates in July, and they give us evidence about that. But given the strength in the yen recently, various Bank of Japan members have told us they're not going to look to raise rates while we're seeing that sort of strength playing through. So I think it's the Norges Bank could be quite an interesting one. They're going to keep rates on hold, and they've been relatively hawkish. So I think Euro Noki shorts look quite good on a tactical basis in that perspective there as well. So, but I think. Going out to next week, Swiss National Bank, that's an interesting one because they've got their own 25 versus 50 rate cut debate. The swaps market's quite delicately poised on whether they go by 50 basis points or 25 basis points. Remember, the Swiss National Bank, they only meet on a quarterly basis, not like a monthly basis like most other central banks. So they need to, if they're going to do it, they need to go hard to do that sort of policy of least regret. So keep an eye on the Swissy next week because the market is saying that we've got another 25-50 rate cut debate there. I don't know. I mean, I think that coin toss, maybe one to stay out if you want to be completely risk averse, but we'll see there.
Well, if you're the Swiss National Bank and things are heating up, obviously in the Middle East, and you've seen this natural Swiss franc bid due to safe haven currency status, if you will. If you were the Swiss National Bank, I know if I was, I'd want to cut by 50. I want to send a message that do not park your money in Swiss francs. That would be my message to the market, and I'd be decisive and I would move. But that's me, and guess what, Chris? I'll probably be trading that way anyway. So
yeah, I think that, an interesting one, a big theme that I'm expecting to play out in central bank lands isn't something that's going to happen now, but I think as we go into November and December, which is obviously a way away, I think there will be a dovish shift from the ECB, and I think we'll start thinking about 50 basis point cuts from them as well. So not for now, but I think that will be a trigger for a decent sell-off in euros, but one to consider. Anyway, let's move on. Let's go to That's a Setup. Well, I'm actually going to go to SOFR futures. What are SOFR futures? Well, they're an interest rate, tradable interest rate. They replaced the euro-dollar system, secured overnight funding rate effectively. So we can trade this. Now, why I've actually brought this up, because I actually use this as a recession guide, Blake. What we've done is we've taken the March 2026 contract, and why I've specifically chosen that one amongst all the different futures contracts that we can have, is because that is the low point that the market is saying that we're going to see the Fed funds rate, effectively where Fed policy comes to. So if you go onto TradingView and you type in SR 3H to 2026, you'll bring that contract. If you take away 100, which is par, effectively what you're going to get then is the yield that the market is speculating that the Fed funds rate will get down to at a low. And you can see that currently at 2.9%. Now, then conveniently, that's exactly where the Fed's longer term neutral rate is that they came out with last night. So what the market's telling me is that the Fed policy is going to go down gradually and get by sort of early 2026 to a low point of 2.9%, which is where the neutral rate is, before, if you look in the future months after that, we actually start seeing rate hikes. Why I'm using this one is because with the market saying that we're going to get right down to that neutral rate before we start seeing hikes again in the new business cycle, is the market saying that we're very much a soft landing camp. Now, at risk of running over time, I think if we were to see fragility come through and this low point in yield going through 280 and specifically through 2.5%, what that is the market then is telling me is that the market is seeing clear recession probabilities and the Fed will need to take it through a neutral capacity into a more stimulatory environment. That's when, to me, risk is really going to come undone. So I'm using this, and I want to offer this as a central guide for traders to be able to understand recession probabilities, because the market is saying at a low point, we're hitting the neutral rate, which is great. This is a soft landing scenario, fully priced in. If you were to see this trading through 250, the low point in yield going into a more stimulatory capacity, that to me is the trigger point for a much deeper risk-off kind of move, higher volatility. So I'm using this as one of my central guides for recession trades. Obviously, we're not there now, and it may not happen at all, but I'm using this going forward. If we are seeing economic fragility, this could be a really, really good way of visualizing the market saying, things are good, or we're going to actually need to see overstimulus coming through.
Well, thank you, Chris, for bringing us that teachable moment. I think people need to understand what SOFR futures are, and it's 2010, and my Eurodollar futures are calling your name. So
it's just a way of expressing a view on future where the Fed funds rate is going to go and future interest rates are going to go. So the fact is, it's the market's saying at a low point in the cycle, we're going to basically get down. The Fed funds rate is going to get down to that to where the Fed are seeing as the neutral rate before rally it before we see rate hikes again. So just using this as an anticipation of where the market sees the Fed policy going forward.
I love it, Chris. Thank you so much, and I'm sure the trade-off community loves it as well. Sorry, stumbling at the end of the day. It's been a long day. My first setup though is going to be the S&P. It's going to be the SPOOs. And like I said, I'm in the sell the news camp. I love the fact that we hit a new all-time high intraday and we reversed. And you can see now we're below that teal, horizontal line that was the previous all-time highs. That suggests that we are going to come back down towards the 50 DMA, if not lower. So I'm looking at this as, if you look at the candle itself, that's almost a gravestone doji, long upper shadow doji, bearish outside day. However you want to look at it, it's ugly as long as we stay below yesterday's or the overnight highs. Now, the 50 DMA is not too far away. It's just above 5,000. And I think the bigger support is going to be the 50% retracement that comes in around 5,400. Those are going to be the levels that I would be targeting on any type of reversal. Has it disrupted the uptrend? No. Is there a capacity for a bit of a reversal and maybe some pullback, maybe some profit taking at this point? Yes, especially once the dust is settled and the market starts thinking, hey, you know what? We might not be getting another 50. Maybe we'll only get another. Maybe we're only going to get the next two meetings. We're only going to get 50 combined. Maybe we're only going to get 25 the next couple meetings. Who knows? Whatever the case may be, it does look like we're setting up for a bit of a pullback as long as we stay below the all-time highs that were posted or are traded during the FOMC.
It's a really interesting one, isn't it? Because with the Fed saying they're going to cut further out, but still really quite confident about the outlook. That to me is still quite a Goldilocks scenario. I mean, that's still a very positive. The Fed put is reinforced. It should be supportive of equities, but we'll have to see on the price action. The market will do what it wants to do. If we do get a break of today's lows, maybe do get that pullback, but we'll have to see. I mean, so much of what we've been seeing in that price action in that candle has been, irrational behavior and flow-based effects from repositioning as we got the facts, that I think the session ahead now and the period ahead is going to be a far more realistic situation about how people are actually seeing this, and therefore, it'll be interesting. So, but the market will do what it wants to do. I think there's an interesting setup, and I think sure a lot of people will be getting it on the radar, as they will do with gold, because the interesting thing, if we were to see Blake's call or Blake's probability playing out, the question is what will happen with gold on the back of that as well. Now, what we've actually seen recently is we've seen these sort of liquidations playing through in markets in risk assets. Reasons for that would be typically quite supportive of gold. The gold market wants to see further rate cuts and increased rate cuts. They haven't got them, so we've seen a little bit of a pullback. And I think really the fate of gold now really relies on what's happening in real rates. 10-year real rates trading around 159, and also short-term yields, the dollar. But we've had that pullback. We've had that rally into all-time highs 2,600. The futures have been trading above that level for a while, and we've now just sort of taken a bit of heat out of the move. So, I think this is one for chasing. If the market rallies, has a bit of a move through Asia today and into US trade, I'd probably be going along with that with a tight stop below yesterday's low, because we're here for a reason. And I think the gold market will be looking much more closely at this idea that, the Fed are, whilst they're calling 25 basis points, I think that they'll probably be incorrect in the sense that if we were to see weakness in the labour market, they'll have to go 50 basis points again, because they really don't want to derail this economic situation. So gold market will there. So if I'm playing this at the moment, I haven't got a position, but if we were to see some buying, it sort of pushes back into 25.50, 25.80. I think that's for chasing, and I'll be going along for that as well.
All right, Chris. Well, thank you for that. And my last setup is going to be the Euro Mexican peso. Bring in the shine bomb government. That she's going to be in. She is coming into power October 1st. That's only a couple weeks away. Bring in the corrupt judicial system. Let's see it. Well, as a result, we have the EURMXN that's near channel support. The EURMXN actually represents something that I find relatively attractive when you're talking about trading. It's a good risk on, risk off barometer, considering the fact that we're sitting near support, near the 618 retracement around the 21.18 level. That's that red 618 Fibonacci level. As long as we hold above that, the risk remains that we trade back higher with the trend in the direction of that red arrow, in the direction of the trend. As the new government comes in, we should see some continued Mexican peso weakness and maybe some euro outperformance, because this is what we'd call a risk on, risk off indicator. So as there tends to be a little bit more risk off, and if I'm right about my first setup, being that we're going to sell the news, we're going to see some downside pressure in equities, the Euro Mexican peso might trade higher from current levels. And I think we trade back up towards 22 in the EURMXN. So bring in the new government, another failed assassination attempt on President Trump, and just bolsters his popularity here in the U.S. And as that happens, I have a feeling he's going to be a little bit harder on not only the new Mexican government, but Mexico as a whole.
Well, not if Billie Eilish. I'm not sure if I pronounced her name correct. I only found out about her name yesterday for the first time. She's now endorsing Kamala Harris, so yeah, she's obviously going to win that one. But there we go. I think interesting times. Let's go to play of the day. Well, I'm going to have a look at dollar yen. Please bring it up, kind sir. Right now, as a rule, when price is above the 5-day exponential moving average, I don't typically like it shorts. I like to see it riding down and go along as a momentum trade, and we haven't got those conditions there as well. So this is kind of more of a setup, but I do see the risk to the downside, unlike you, Blake. And I think if you get your lower equity call, then I think the yen's going to do well again. I think you're going to see if you were to see weakness coming through, I think you're going to see dollar yen trade lower. But I want to see a daily close below that 5-day exponential moving average, which isn't the case at the moment. And then I'll look to jump on. So I've just got this as a setup at the moment, but yeah, looking very closely, and I think the probabilities are this goes down. And I also do think that, all the risks to the labour market in the US are for higher unemployment rates, for signs that we start seeing layoffs increase. I think that's where all the signs are suggesting at the moment. The US economy is obviously running pretty hot at the moment. It's certainly not collapsing, but it is cooling. But I think, the risks to the unemployment rate are higher. And we'll start seeing that evidence soon. Doesn't mean we're going to see dollar yen necessarily collapse now. But I think that the risks are for dollar yen is still for lower levels. And I think, the Fed will have to be forced to revisit that 25 versus 50 debate in the November meeting. And then, the election could be a dollar positive, depending on the outcome. I think that there are downside risks to this currency pair, and I think if we get a close below that 5-day exponential moving average and it starts to trend lower, I'm jumping on board, and I think that goes 138, 137.
So Chris, just for the record, I do not disagree with you. I think we overall are going lower, but I'd like to see a little higher first before lower. That's I'm trying to play it.
So there's selling into strength, and then there's selling into momentum, and I'm choosing the other one.
Okay, and here's the thing, Chris, is what I think or what you think, and what we think happens and what actually happens can sometimes be two totally different things. I try to plot out what I think is going to happen and trade that plan, but my plan never. Well,
it doesn't matter what we think; it's what the collective weight of money does. Right. And what we're trying to do as traders is just trying to align ourselves to where are the probabilities with that weight of money? That's really what we're doing.
Well, okay, speaking of which, I think this is going to be a good one that plays into that. Let's talk about my play of the day, which is going to be the dollar CAD. And I'm going to have to give you not a mansplainer. I'm going to have to give you an American splainer. Mrs. Butterworth, for those of you that don't know that, is actually a syrup that is, I forget the name of the company. I just said it, Conagra, US-based company syrup. It's not maple. So this is basically me, a cheeky way of saying I'm long dollars selling maple syrup or long Mrs. Butterworth. Anyway, we talked a lot about this over the last couple of months, Chris, how the CFTC positioning was so skewed that for hedge funds or fast money, they were all short dollar CAD. When it slipped through 136, 135.90, it crushed everybody. You see those big red bars there like a month ago. Well, we've since then recovered. And if we get above the 38% retracement, which is 136.35, I think that we're going to be chasing that thing higher above the 50 DMA, which is that orange moving average. I personally am long the dollar CAD. I'm looking to add into strength dollar CAD. I am playing dollar long, as I've been, trying to illustrate, over the course of this entire show. And this is how I'm going to play it. I'm already long. I'm looking to get more long, and I'm going to be buying some Mrs. Butterworth. So there you go, Chris.
I'll have to try some of that. I'm not sure if I can take food advice from an American because, obviously you still think that filter coffee's a delicacy. So,
it's corn syrup, buddy. It's just pure corn syrup. You don't want it. You don't want it.
It keeps you awake. That's probably what gets you going in the morning, eh? Anyway, a lot going on.
It would do that.
A lot going on in markets. Let's see what the reaction when calmer heads prevail to the Fed meeting. Have we learned anything new? I'm not sure if we have, but the market will tell me what they're thinking, and Blake as well. And you guys at home, we'll see you back next week for more of the trade-off.